Okay, hello everybody. Today is Wednesday, June 14th. I can't believe the month is already halfway over, but that's what it is. So let me go to my slideshow. Okay, so today I wanted to touch on a couple of strategies that we had kicked around here before, and just, definitely want to get input from you guys on what you think of them and all that. But so we're gonna, we've been talking about the 7-day SPY, and then also I just named this the mini diagonal call, and this is kind of came out of the sector rotation trade we've been looking at. So that's kind of what that is, and it's kind of a substitute for doing that in the money covered call on the ETF, or in the money. So so really the SPY trade is really to take advantage of the overstated option pricing and having theta work in our favor. So the first part is generally what happens is when the price, when the market makers price options and they consider what the expected move is, about 2/3 of the time they've understated that. So if they think it's going to move 8, it generally will move less than 8. Does that make sense? So they've overstated the expected move. And then theta, really works to our advantage as you get closer to expiration. So the 7-day kind of takes advantage of that rapid theta. And then the mini diagonal was just really kind of a side comment that Sharish made to, hey, could we do it like a poor man's covered call on those in the money covered calls? So one thing I would say about that, you can't set it up for an in the money covered call, but you can set it up for like an at the money covered call. So that's kind of one thing just to keep in mind there. So that's what we're going to talk about today. So just at the basics, what is an iron fly? So we kick that term around a lot. What is an iron fly, an iron butterfly? It's simply where we are trading a call spread and a put spread, but we're setting the short strikes of the put and the call at the same level. So it's an iron condor just collapsed down, so the short strikes are at the same exact level. And the whole thesis of this trade is that the price of the stock or the ETF or whatever we're trading won't move further than the expected move. So that's kind of the idea. It says we don't think it's going to move as far as the expected duration. And if it does, then we don't win on the trade. If it stays below, which historically 2/3 of the time it's less than the expected move, we're going to win. So, and typically the expected move on the SPY over 7 days is about $5 to $6. That's kind of the range, and it'll vary a little bit just depending on what the IV and all that kind of stuff is, but generally about $5 to $6. Is that about your expectation, Bill?
Yes.
Okay. And so the trade would be to sell a 10 wide iron fly expiring 7 days out. And SPY will have an expiration every day of the week. So you don't have to put them on all the time. I know, Bill, you said you wait for one to come off before you put the next one on. You could do it any way you want, but I would recommend not doing, every day. I would come up with some way like Bill did, or do it 3 days a week or things like that. But the trade would be when you put it on to sell the iron fly, 7 days expiring, and use $5 wide strikes. So here's what that looks like on Tastyworks. So, and I use the white background. I think it makes, hopefully it shows up a little better than the black background.
Yes.
But so at the time, SPY was at 438. So I sold the call and the put 438. On the call, I went up 10. Whoop, well, I was thinking I was on my chart. And on the put, I went down 10. So in this case, it paid me $5.38, $538, and my risk would be $4.62. $462 is the risk on the trade. That makes sense, everybody? So a couple things. Oh, over here in the right column, you can probably barely see it, but it says the expected move is 5.76. So that falls in that $5 to $6 range. So they expect the move to be basically 5.25. We're going to get paid $5.38. If it doesn't move beyond that 5, this will be a profitable trade. So that's kind of the way that it's set up. Everybody with me there? Okay, so here's the details of the trade. So we're going to sell the 438, 428 put spread. I added an extra 4 there. On the call spread, 438 or 48. So we're always kind of going away from the thing selling to long call. We received $538. The total risk is 462, which is simply $10 wide less 538. So the most we could make on this trade is $5.38. And that would only be if at the end of the week, Bill, I'm going to mute you just because I got some background noise. Okay.
Okay.
You just unmute yourself if you want to, when you want to talk. Okay. So, so a lot of people will say, wow, this is a great trade. I could make $538. The reality is you're not going to make $538. You would have to nail it to the, right at the dollar to get $538. So, the max profit is this. The max risk would be if the SPY moved more than 10 points at expiration, then you could have a max loss. And the other thing that that I know can happen is that this trade does have assignment risk. So if you're trading something like the SPX, you can't be assigned, it's cash settled. But, say on this trade, we sold the 438 and it drops to 435 and you get close to expiration, you could be assigned that at that 438 strike. So just that's kind of important to know that you do have assignment risk. Any questions on that?
If you were to get assigned, then would you just go right ahead and sell it?
That's what I would do. Yeah. Because if you sold the put, you're going to be long 400 at 438. If you sold the call, you'd be short at 438 if assigned. So if it's in an IRA, they're not going to let you hold the shares short. But you could, if you wanted to say, okay, I'll take the shares, you could take the shares. I don't think it fits in this strategy because it's an at the money call to start with. Okay. Here's some trade rules that I thought made sense. I would only enter this trade when the RSI, relative strength index, is between 40 and 60. If the SPY is oversold or overbought, I wouldn't put this trade on. And the reason for that is if it's up to, like, say it's at 70 or was at 70 when this meeting started, there's a more a higher tendency for that price to revert back to the mean. So that's kind of why I would not buy it, put this trade on unless the SPY was in a neutral status. The second thing is I wouldn't enter this trade before an upcoming major economic event. So today would have been the terrible day to open up a SPY iron fly, because what's going to happen is that we knew that the market would move somehow today, right? I mean, we knew there'd be some reaction to the FOMC, either positive or negative. This trade benefits if we don't have a big move. So what we want is this kind of calm, smooth sailing along the way. Does that make sense? So you just don't want to be kind of setting this up as you have a big, economic event. The second thing is, and I got this idea really from you, Bill, about taking profits somewhere between 10 and 20% of the credit received. So we're not trying to like hit a home run. We're just trying to make a quick profit on the trade. So if you think about it, if you collected $5 on the trade, your risk is $500, right? So if you made $50 out of the 500, that's a 10% return. So that is kind of a nice sweet spot. Now you could do 20%. I've seen people do 30%. But what I think is the higher you shoot for that credit capture, the more risk of that stock moving one way or the other. Would you agree with that, Bill, since you've been doing them more than?
Right. I think I got that rule from you that
Oh, yeah.
you first presented, you said take profit at 15%, then you dropped it to 10.
Yeah. So I just,
right.
yeah, I just, it's in that range. You can set whatever you're comfortable with, but I think in today's kind of market environment, 10 to 15, even 20% would be what I'd shoot for. I wouldn't try to get 50% or anything like that, because it's just, you run the risk of it moving against you. And then this is something that I added, just kind of walking through the strategy, is if it moves more than 5 or 6 points against you, I just get out of the trade.
No.
And then the other thing is I would exit this trade 2 days before the expiration, no matter where I was. So if I didn't hit my 10% and I wasn't within 5 points, I would close it out, because the risk there is, think about this. One of those 2 strikes is in the money. So you gotta trade in the money no matter which way it moves. So what you have is assignment risk. So if it expires on the 7th and on the 5th, I'd be closing the trade out. So those were kind of rules that I thought made sense to improve our success rate. Any questions or feedback? Did I miss any rules that you guys can think of?
No.
Okay. Now, I've actually heard other people will say, instead of selling an at the money strikes, what they might do is, if the stock is moving up, they perceive it's moving up, they might scoot that short strike up 2 points or down 2 points. Nothing wrong with that. It's a little bit of a skew kind of thing. So if you kind of think, if it's at 450 now, and you say, I really think it's going to move to 453, you could sell the 453 iron fly. That's all I'm trying to say. But I would probably pretty much, if it's in the middle of that range, I'd sell the at the money. I think you have the best chance of success at that point. Okay. Any questions or feedback? Oh, here's Bill's spreadsheet that he sent to us, and his rate of return, he said he's averaged about 3 days in a trade. Bill, is that right? You're muted, Bill.
Yes,
Okay, so that's a pretty good time frame, and you open one up only when you close the other one out, correct?
right.
Okay, and I like that idea. I think, what you don't want to do is have 5 trades open, because it's a lot of numbers in the same same neighborhood. So I like the idea of putting one on, getting off, closing it, resetting another one. So those are the rules that I thought made sense on this strategy. So anything you want to add, Bill?
Oh, the move in the last week wiped out all the profits.
So yeah, I mean, I think
So, that's
you
a
know
20% losing ratio. on
okay.
these.
Yeah, I mean, it's a tough strategy when the market is, I would say, not unstable, but just a little bit where we see wild moves. But it's a cool strategy, and hopefully, if we add these rules in there, we can minimize the losses.
I think you need at least a minimum of $500 in net premium. It needs to be pretty close to what the, as you said, the
Yeah,
expected move is.
right. And I think that, yeah, I think that's probably a good rule to add. It's going to be your credit should be equal to the expected move. Okay, so that is the iron fly. So once those rules kind of get met, I'm going to try a few of them. But right now the RSI was like 73. So it wasn't really a good time to enter one. So I didn't even try one. So, okay. So the next strategy, any comments or questions before I move on to the next strategy? Okay, so the next one is was an idea that Sharish had mentioned, and after the call, I kind of played around with it. So I call it a mini diagonal call. It's a diagonal call. It's just using shorter dates. So in this case is if we look at those ETFs that are in the hottest sectors, and we say we could sell an at the money covered call, we could sell an in the money covered call, we can sell a put spread. All 3 of those methodologies are good, right? If you sell the in the money covered call, any covered call, you got to buy at least 100 shares of the stock. So that, for some people, they don't want to tie up that much money in the stock. So second alternative is just do it as a put spread. And I know, David, that's what you do, right? He's there. Okay. So if you do it as a put spread, you could have $1,000 in risk less the credit received. So it works. You'll get a little bit less credit, but a higher rate of return than the in the money covered call. This third idea was just doing the same, trading the same ETF, but trading it like with a diagonal call. And here is here's the first one that I did kind of after that call. So this was in ITB. It was the Builders ETF, and on 6/8, the stock was selling, or the ETF was selling at $79 a share. So I went out about, 22 days, bought the at the money call, paid $1.78 for it. And at the same time, I sold a June 1681 call. So had a $2 of upside, collected 35 cents credit. So the net of the trade was $1.43 in the trade. And I closed it in 5 days. I think probably just maybe yesterday that we put that close that trade. So I closed it for 204, which means we made, $26 per contract, but that was 43% of the return on risk. So if you had said, I want to do, $500 in each trade, that you would have done, 3 or 4 of these guys, and it would have been a really nice return. And it really didn't even get over 81. So that was one trade we did. Anybody do this trade, or y'all just watch me to see how it turned out? I don't blame you. So this is one I put on today. I did it in XLK, and it was trading at 172. I bought a July, so I went out about a little over a month, bought the July 175 call and paid $2.96 for that strike. And then I sold the 180 call that expires on the 30th and collected 47 cents. So it cost me about $2.50 per contract. So, and the stock, the 75 call was something about a 41 delta. So what I said here was, if the stock moves up to 180 by June 30th, then the long call should go up in price by about $3. So we paid $2.96. If it moves up to 180, we'll double our return there on the long call. So that's what's pretty interesting about the diagonal call. And the other thing is, the most we could lose is $2.49 per contract. So if we bought the stock, we would have to pay $17,000. If we did the put, it would cost us $1,000 less to credit. This one has a debit of $249. And if it doesn't move up to 180 and we still are bullish on the ETF, we could sell another call against it. So that's the idea of the diagonal call. Any questions or feedback on that? Do y'all like this strategy?
I don't know. I just have to try it.
Yeah.
But it's one that you're bullish on.
Yeah. So this would be, we would select an ETF out of that hot sector list. So our thesis is that it's a sector that's doing well. We're selling basically a poor man's covered call in it. So that's kind of the idea there. So this is just another way of kind of trading that hot sector thesis. Of course, I'll build some trading rules in it, right? You wouldn't expect any less. I would buy the call closest to the at the money 20 to 40 days out. I'd sell a call somewhere between 10 days and 2 weeks. And I like the call that's just outside the expected move. So you don't want to have that thing be so close to your strike, to your long call strike, that if it moves a couple points, then you got the issue of it's in the money. So I like it selling a little further out. And then if the trade gets close to my short call by the expiration date, I just close the trade, take the profit, and redeploy the assets. And like I said just a minute ago, you can roll this short strike out after the first one and further reduce the credit. So so you could theoretically, on this trade, let me just go back to it. If you could get 47, 3 times, you could reduce the basis down a couple bucks without too much trouble. And that's it. So what do y'all think of those strategies? Bill, you were really up on the SPY thing, and then I guess it just moved against you recently. But I think it's a strategy that makes sense in the right kind of environment. And then I kind of like the diagonal call, especially if we think the market might be turning a little bit more bullish, that we would kind of look to do that and try it. And it has really low kind of overall risk is pretty low. So that's another big plus on it. So it's kind of like you could have, buy the calls. That's the most expensive, makes the most money. The put spread makes close to the amount with a lot less money, and the in the money makes even a higher rate of return with the least amount of capital. So anyway, that's why I wanted to share that with you guys. So any other questions or feedback? Okay. Hey, Charlie.
He says, hey, I was gonna mention on the mini diagonals, it would be nice. I guess we can see based on how it moves. It would be nice if the long call stayed above the premium that you got for the short call. So you at least are breaking even if it didn't go your way.
Yeah, that's
That'd be
kind of the
ideal.
Yeah, I mean, that would be the ideal for sure, because then you really theoretically have no risk to the downside, right?
Sure.
But the
Which it
problem,
might, unless it just totally drops.
yeah, and the only problem with being too aggressive on that short call is then it moves past it, and then you got all that kind of stuff to deal with. So I think it's
I'm doing that right. I'm doing that now. So yeah.
So it's a balancing act. That's why I tried to go, what's the expected move, and pick a strike right outside that. So the other thing on those ETFs is sometimes on the ETFs, there isn't as much open interest on the off week strikes. I don't know if y'all have run into that yet. So you have to kind of play around with it and look for where, what weeks to use based on the liquidity. It's surprising. You'd think that these ETFs would have tons of liquidity, but some of them are just horrible liquidity. And the pricing in some of them are really bad. So just be careful if you're picking something. Look for ones that have good open interest and the bid ask is reasonable. Okay, hope this has helped. We'll try some more of those and I'll share them with you. I just wanted to kind of spend a minute at least telling you what my rules were. I'll put the slides out shortly. And but if you do have any questions or even suggestions of rules to add to it, I'd really love to hear from you. Okay, I'm going to stop the recording.